Joining us on your computer or tablet or phone this afternoon. I'm Carly Sapola. I'm the Director of Operations for the American Solar Energy Society. And thanks again for joining us in our monthly webinar series. The American Solar Energy Society, ASES, is a 501c3 nonprofit organization established in 1954, advocating for sustainable living and 100% renewable energy by sharing information, events, and resources to cultivate community and power progress, such as this very webinar. So welcome to our September webinar. Before we get started today, I'd like to give you all a short update about ASES programs. Want to let you know, take a peek at the poster I'm sharing with you guys to save the dates for our 50th annual National Solar Conference, Solar 2021, Empowering a Sustainable Future. This will be taking place in Boulder, Colorado at the University of Colorado Boulder from August 3rd to the 6th, 2021. We're planning to open up the call for participation on October 1st, and we look forward to receiving your submissions. Be sure to keep an eye out for any updates by signing up for our email list at ases.org or checking out the website for our conference, ases.org/conference. You can also learn more about upcoming ASES events and our partner and chapter organization events at ases.org/ASES events. We've got a lot of fun stuff coming up in regards to the National Solar Tour. So feel free to keep an eye out. Sign up for your local solar tour or open house by September 23rd. The deadline has been extended from the 15th to the 23rd of this month. So sign up now at nationalsolartour.org. If you don't have anything to share, please RSVP as an attendee at nationalsolartour.org. We look forward to seeing you virtually online this year for the National Solar Tour. I'd also like to remind everyone that our webinars will continue to be free during this unprecedented time. You can learn more about the webinar series at ases.org/webinars. Now it's my pleasure to introduce you to Stanley Fishbein, who will be presenting today's webinar. Providing leases and loans to commercial and industrial companies nationwide for their acquisition of solar systems. With more than 35 years of diversified equipment leasing experience, Mr. Fishbein has held positions in the commercial equipment leasing subsidiaries of ABN AMRO Bank, Chrysler Corporation, Citibank, and Textron Corporation. He holds a Master of Law degree in taxation from Boston University School of Law, a Juris Doctorate degree from Suffolk University Law School, and a degree in accounting from the University of Massachusetts. Please send in any questions or comments that you have during the presentation into the Q&A section of the webinar, and Stan will answer these all at the end of the presentation, but feel free to send them in throughout the presentation, but we'll cover everything at the very end. Without further ado, I will go ahead and let Stan take over for his presentation of ASES's September webinar. Enjoy.
Okay, thank you, Carly, for that nice introduction, and thank you, American Solar Energy Society, for the opportunity to speak today. Good afternoon, everyone, and welcome to today's webinar. I hope you find today's session to be helpful in promoting the adoption and use of the world's most abundant energy source. I think you know which one I'm talking about. Let's start by looking at today's agenda. First, I would like to briefly share with you how I got involved with solar. I will then review a business owner's objectives when considering solar, and follow with a graphic cash flow comparison of the financing methods that I will be discussing today. Next up, I will highlight the benefits and incentives driving solar's economic attractiveness, and follow by describing and comparing the several financing methods: loan, lease, PACE, and PPA. I will then share my observations how the coronavirus pandemic is impacting solar economics and these several financing methods. There will be time for questions after my presentation. First up, my background. As a big believer in education, I became a tax lawyer and accountant and spent my early career developing cost-saving tax strategies for clients. This led to more than 35 years in the commercial equipment leasing industry, where I utilized my knowledge and experience to provide optimal financing solutions to clients acquiring equipment. While networking with renewable energy professionals, I met Wilden Fishman, founder and president of the New York Solar Energy Society, a chapter of the American Solar Energy Society. I became a board member of the New York chapter, and through the programs that we developed, I learned a lot about solar and renewables, as well as climate problems and solutions. If you are interested in these topics, I highly recommend you join the American Solar Energy Society in a local chapter. Your financial support and active involvement will be mutually beneficial, I assure you. My popular presentation at New York events, Making Solar Affordable, was the catalyst for the Clean Energy Ownership Program, a program that I created for companies seeking a financing method that would optimize value by using a traditional operating lease as an affordable path to ownership. So why do business owners want to go solar? More and more, these company owners want to demonstrate to their like-minded customers that they are concerned about the devastating effects of climate change and are doing their part to help. Sustainability goals are also becoming more popular at public companies in response to the environmental concerns of their shareholders. This will be a long-term trend as we witness the growing number and intensity of extreme weather events around the world. On this note, my heartfelt condolences go out to all the folks who lost their homes and livelihoods this year. Meanwhile, all business owners like to save money and conserve cash for use in their business. The mantra, cash is king, is back. So it is no surprise that an immediate saving in electric costs and locking in a long-term levelized cost of energy is of interest to companies of all sizes. Conserving cash for use in the business will increase profitability and help grow the business when the electric savings are put to work back in the business. Likewise, financing the purchase of a solar system rather than paying cash will free up funds for use in the business. There are two examples I like which demonstrate why conserving cash for use in the business is important. The first example is where having more cash in the business may reduce the need to draw down a bank line, which will reduce interest costs and thereby increase profitability. And the more cash on hand will help maintain balance sheet ratios required by the bank line. The second example is more compelling. Assume that a company with a 20% profit margin turns over its inventory twice a year. In this case, would you want to pay cash to purchase a solar system or finance your purchase and earn a 40% annual return on the freed up cash invested in more inventory? I think the answer is a no-brainer. So, unlike an all-cash purchase of a residential solar system, the alternative use of freed up cash in a business is an important consideration for business owners and should not be overlooked. As I review the slides that follow, keep in mind that savvy business owners' mantra is to increase profit, grow the business, and build long-term value. Increase profit, grow the business, and build long-term value. Based on a recent commercial project in California, this graph compares at the end of each year the cumulative after-tax cash flow to the customer, paying all cash versus several financing alternatives. a traditional operating lease, PPA, or commercial PACE. The all-cash purchase maximizes long-term value, but deprives the company of cash that could be used in the business during the early years. The traditional operating lease in this example provides a positive cash flow from the first year and tracks the all-cash alternative closely once the all-cash alternative enters positive territory. The PPA alternative of no cash down and always cash flow positive does exactly that. It falls far short of building long-term value comparable to any of the other alternatives. And this depiction does not include any fair market value purchase by the off-taker of the PPA that would exacerbate the difference. PACE is an attractive alternative for customers who are willing to give up some long-term value for greater cash flow in the first half of the solar system's life. However, as we will see in later slides, there could be tax benefit limitations, credit requirements, or financing features that would affect the after-tax value or relative appeal of a particular financing method. But first, the next slide presents the assumptions behind this graph and provides the dollar amount of the cumulative after-tax cash each year for each alternative. If difficult to read, don't worry. A copy of this slide is included in the slide deck that will be available after today's webinar. The financing terms reflected in the after-tax cash flows are as follows. The traditional equipment operating lease is 7 years with a 15% end-of-term purchase option. The PPA is 25 years with 20% first-year savings and 0 escalator. Commercial PACE is 20 years with a 5% interest rate. The cumulative after-tax cash flow for each alternative after 25 years is approximately $3.2 million with the cash purchase, $3 million with the traditional equipment operating lease, $2.5 million with PACE, and $1.7 million before exercising a purchase option with the PPA. As most of you know, the federal income tax credit has been a big economic driver for solar. Previously at 30% of system cost, the investment tax credit is currently at 26% and is scheduled to step down to 22% in 2021 and 10% in 2022 and all years thereafter for non-residential systems. Solar systems also qualify for 5-year accelerated tax depreciation and are eligible for bonus depreciation, which provides for a deduction of 100% of the equipment's depreciable basis in the first year. In addition to renewable energy certificates, there are a variety of local and state incentives, including grants, performance-based incentives, and feed-in tariffs. The takeaway, when deciding between financing alternatives, it is important to know what incentives are available and how they will be allocated and shared between the parties to a financing. The loan is a familiar financing method whereby money is borrowed to acquire solar system ownership and will be paid back with interest over time. Loan approval is typically based upon the company's credit profile and the personal guarantees of private company owners. The loan is secured with a lien on the equipment and possibly also on the realty where the solar is to be located. The tax benefits for the system owner, ITC, equipment depreciation, and interest expense deductions, also energy savings, RECs, and local and state incentives for the system owner. Very straightforward. The most popular type of equipment lease is known as an operating lease in accounting terminology. It is simply a rental agreement. I use the word traditional to distinguish it from the solar industry lease, which has features making its value proposition similar to a power purchase agreement. With an operating lease, the lessee pays rent to the equipment owner, the lessor, the use of the equipment during the lease term, and either a purchase option is exercised or the property must be returned. The lessee is not borrowing money, so no debt is incurred and no interest is paid. The rental payments are 100% tax deductible as a business expense. Lease approval is based upon the company's credit profile, and the lease is secured by the equipment and typically the personal guarantees of the owners when it's a privately owned company. Tax benefits, RECs, and local state incentives are for the lessor and may be passed through or shared with the lessee. Because ITC is the big economic driver for solar, it is crucial to understand where its value may be realized. Limited liability companies, S corporations, and partnerships cannot use the federal income tax credit because they do not pay income tax. In other words, there is no tax to be offset with a tax credit. These so-called pass-through entities pass their taxable income and any tax credit to their owners in proportion to each owner's ownership interest. Some owners may be able to use a tax credit on their personal income tax return, while others may not, resulting in a loss of value. However, even when the owners can use the credit in full, saving personal taxes does not conserve cash in the business, where it is needed to increase profit, grow the business, and build long-term value. Because most privately owned companies in the US are pass-through entities, this is a big problem. The traditional equipment operating lease is a solution to this problem when the lessor monetizes the tax credit and shares the value with the lessee by subsidizing the lessee's payments. The ownership cost comparison of the traditional operating lease versus a loan is an eye-opener because it dispels the notion that the customer is giving up a lot of value to the lessor when the lessor takes the federal income tax credit and initial depreciation deduction, as long as some of that value is shared with the customer. Indeed, based upon this $1 million solar system and currently available terms from Cleanview Capital, this comparison demonstrates that C&I customers retain $338,000 more cash in the business and achieve a slightly lower after-tax cost of ownership when using a traditional operating lease as a path to ownership rather than taking ownership from the get-go and financing the purchase with a loan. In this way, a traditional operating lease, when combined with an attractive purchase option, while not technically a financing, may serve as a de facto method of financing a company's acquisition of the equipment. It is also important to consider that the ITC would be passed through to company owners, as well as how the cash retained in the company may be used to increase profit, grow the business, and build long-term value. Again, this slide will be in the deck that's available to all of you after today's presentation. The following list of differences between a lease and a bank loan highlights some of the additional requirements that may be imposed by a bank lender. The lease amount is 100% of equipment cost versus a possible loan-to-value limitation with the bank loan. There are no restrictive financial covenants with the lease, no compensating balances, when you do the lease will preserve existing bank lines, and the bank may require a lien on the realty as well as the equipment. The takeaway is the lease conserves cash to be used to increase profit, grow the business, and build long-term value. PACE is a government legislated financing program involving a long-term loan that is repaid through property tax assessments. It is typically a 20-year term with an interest rate between 5 to 6%. Loan approval is based upon the owner's equity in the realty, and the loan secured with a lien on the equipment and the realty. Tax benefits are for the system owner, the ITC and equipment depreciation, and the energy savings, RECs, and local and state incentives are for the solar system owner. The traditional lease versus PACE, both are non-debt obligations. The lease solves the ITC monetization problem, not PACE. There is no lien on realty with the lease versus a long-term special property tax encumbrance when doing the PACE. No interest paid on the lease versus a high total interest paid when considering repayment on PACE is over a long period of time. The lease is credit-based approval, where PACE is an equity-based approval. This could make a big difference for a particular customer. Also, personal guarantee is typically required on the lease, where no personal guarantee is required on PACE. Because again, PACE is primarily focused on the real estate and the value of the real estate, as opposed to the credit of the customer in other programs. The lease is straightforward, familiar, and short versus unfamiliar documentation that a customer would be reviewing for the first time with PACE. The takeaway is the traditional lease provides greater long-term value for companies that have an acceptable credit profile. PPA and the solar industry lease. I refer to the PPA and the solar industry lease as first cousins because these are cost reduction programs that are based on the same economics, structured around the long-term purchase of solar energy, typically at a nominal discount of 10 to 20% from a customer's current utility rate. These programs provide a hedge against utility price inflation and are typically 15 to 25-year terms with anywhere from 0 to 3% annual escalation. Approval is based upon off-taker's financial profile, which is less stringent than a bank lender's, and secured by a lien on the equipment and the realty. Tax benefits, the ITC and depreciation, and RECs and local and state incentives are for the system owner who, under this program, is the program provider. The traditional lease versus the PPA or solar industry lease. There are fixed payments with no escalation with the lease, a possible difference. All local and state incentive payments would go to the customer under the lease. The full displaced cost of electricity is savings to the customer with the lease. No lien on the realty, and again, straightforward, familiar, short lease documentation. All that makes for a quick, affordable path to ownership. The takeaway is the lease provides greater long-term value to the customer. Okay, some observations, what we're seeing in the marketplace today due to COVID-19. Companies are experiencing reduced cash flow and taxable income. with some exceptions, but many are in that situation. And for those, they are less likely to pay cash or use a loan or PACE to finance a solar system purchase if they have to defer value from the ITC due to their reduced tax capacity. Some PPA and lease providers are facing a similar constraint, and due to having less value to share with customers, have either increased pricing or temporarily exited the market. Credit requirements have tightened, making credit-based approvals impossible for companies reporting losses, as well as companies in some of the hardest hit industries, such as hospitality, leisure, and car dealerships. As a result, projects have been delayed for these reasons, as well as the fact that utility personnel and town employees are working from home. So there's been a slowdown in permission to proceed and permission to operate approvals. So companies having put capital projects on hold unless they can be made affordable. And that's where one or another of these financing methods may be helpful in unlocking a frozen market and getting it moving again. Thank you for your participation in today's webinar. I will answer questions as time permits, and if we run out of time, feel free to contact me at stan@cleanviewcapital.com. We are now ready for Q&A.
Okay, great. Thank you so much, Stan. We can start reading through some of the questions that we have in. Are you here, Stan? Looks like you might be muted.
Yes, I am. I'm here, Carly.
Oh, hello. All right. So we've got a question in from Mary Gosling. Trying to get solar panels on our building housing 50 condominium homes. Owners are very weary of the long payback period. Do you have suggestions for financing this project?
Well, payback is an important consideration. And my suggestion is to reduce, payback involves looking at the project as money invested in the project. So if you pay all cash, you have 100% of project cost invested from the get-go. If you were to use one of these financing methods, it would reduce the amount of your upfront investment and replace it with payments over a period of time. And my thought process is that those payments should be viewed as a relatively small investment, part of your investment, which would be the upfront investment plus these ongoing monthly payments, and compare that to the project cost. And I think that way you may be looking at a lesser amount invested along the early years of the project rather than paying all cash and having a larger investment up front. So cash invested, payback is important, but payback is only one method of looking at your return on investment. If you talk to CFOs, they put more weight on a net present value calculation or an internal rate of return calculation to see if it's worthwhile, first of all, to do the project, and second of all, what the return would be on your invested dollars, and not simply the sophomoric payback way of looking at a return. If you're interested, Mary, I could send you an article, a reprint from the Harvard Business Review that talks about why the net present value method is a preferred return on investment metric used by CFOs around the country, much more so than this concept of payback. Just email me at stan@cleanviewcapital.com, and I'd be happy to get that right over to you. Thank you for the question.
Great. We've got another question in. John Ward is asking, a large cost in PV systems is installation, and with a lease, removal gets added in a lease. Does installation by the lessor become a depreciable cost and eligible for the ITC?
The short answer is yes. When we provide a lease to a company, it's 100% of the so-called project cost, which is not just the hard cost of the panels and other components, it's the all-in price, including labor, soft costs, engineering, etc. And the ITC is claimed on the full 100% project cost. Thank you for the question, John.
And Kurt Zwally just sent in a comment that said, great presentation, Stan. Thank you. And we've had quite a few questions coming in asking if the presentation will be available afterwards. And yes, Stan, will you be sending me your slides to share with everyone, or do we just want to send the video?
Oh, I'd be happy to provide all the slides, Carly, so that you can follow up and get them out to folks.
Perfect. So I will do that for everyone on. Want to let you know I will send you the presentation along with a link to watch the webinar again if you're interested by the end of the week. Right. And we have a question from Drew. What is I guess I'm not really sure how to read this, so I will move forward to a question from Batu Varlik. We project PV systems for industrial facilities in Turkey. Does your company have any plan for such projects abroad?
A good question. Unfortunately, no. Our program, using the traditional operating lease, relies to a large extent on U.S. Tax benefits, which means that the equipment has to be installed here in the U.S. But thank you for the question, Batu. Also, going back to that other question, if people are in a hurry to get copies of my slides, feel free to email me directly at stan@cleanviewcapital.com, and I will get you back a set of slides today.
Perfect. And John Ward has asked another question. Can you expand on the first year bonus depreciation? Was that shown in any of your 4 examples on that slide? I recall a federal stimulus like this a few years ago for all businesses, but I thought it was short-lived and expired.
Okay, good question, John. These tax benefits are well, they might vary somewhat depending on who is claiming them and if they're claiming them. So the graphic presentation does not include bonus. Well, you know, if it's, I can tell you with the equipment operating lease that bonus depreciation is embedded in the pricing. I can't speak for providers of these other programs. But also the first year bonus depreciation applies, you correctly pointed out, to all equipment types, all assets, frankly, acquired by a company. It's not something exclusive to solar. And companies do have the option of opting out of claiming first year depreciation and just taking the the maker's depreciation. And depending on the asset and the class it's allocated to, it may be 5 years, 7 years, 10 years, etc. Also, the bonus depreciation at 100% of depreciable basis is scheduled to start stepping down after a couple years by about 20% per year. So eventually that goes away, and you're left with the regular maker's depreciation method. But good question, John. Thank you for the follow-up.
Great. Got another question from Jay Ritchie. How do you calculate the fair market value for purchase of a system in a PPA agreement at year 8, assuming initial cost was $1 million?
Not being a PPA provider, I can't speak from my personal experience, and that's going to vary from provider of those programs, which is kind of why it's sort of like a little bit like the wild west as far as I'm concerned, when there's a provision for a fair market value at the end of the term of these agreements, and there's no industry standard, and basically up to the PPA provider to address it as they may. But good question, John. Jay.
And a question / comment from Drew. Stan, you assumed a 5.95 loan rate. How much lower is now available, and are there reverse results?
Oh, okay, Drew, in answer to your question, that is a rate that's currently available from Cleanview Capital for transaction size $1 million or more. It could be different, obviously, from other loan providers. I can't speak for others. It is reflective of the dollar amount of the transaction and the quality of the customer, the credit quality. But I can say this, that you could take that interest rate from 5.9 down to 3.9 or 2.9. And the bottom line result is that you're still going to have a comparable after-tax cost of ownership, whether you do the operating lease or the loan. And so the point I was trying to make in that slide is not necessarily that you achieve an after-tax cost of ownership that's lower with the operating lease, but one that is comparable to the after-tax cost of ownership when using a loan. Because from a customer's point of view, when all things considered are pretty much equal on an after-tax basis, they've come back to me and said they prefer to do the operating lease versus the loan because they're more concerned about conserving cash in the business than taking the ITC on their personal tax return and saving personal tax dollars once they see that it's pretty much comparable after-tax cost to own. And that was ties in with a point that I was trying to make that during my presentation, if I was not clear, with the operating lease, the ITC is not passed through to the customer. I was trying to say with the loan, the ITC would be for the customer. On the operating lease, it's obviously monetized by the lessor, and the value is shared with the customer, which is why when you look on this $1 million project, the customer's all-in payments are only about $880,000.
Okay.
Thank you for the question.
And another kind of question comment from Nikolai Robles talking about the opportunity to put solar energy in parking lots. He has a project to take advantage. Every school in his territory to put solar in the parking lots, but they need to install canopies in some cases that will cost extra. Do you think going forward with that variance that it will still be profitable. Also, as the schools are diversified, they will be great contributors to DER plans.
Okay, very good question, Nikolai. I should point out that this operating lease is not available to non-for-profits who are tax-exempt entities. Why? Because tax law says that a lessor cannot monetize the ITC when the lessee is a tax-exempt entity. And by the way, that's been in the tax code since the 1986 Tax Reform Act, so I don't think that limitation is going to go away anytime soon, which is also why you see the preferred financing method for these school districts and other non-for-profits being a PPA as opposed to an operating lease. There is another product that's available that's called a municipal lease that would provide more value to the customer than a PPA. But once again, neither party is claiming the ITC. What makes it attractive, it's really the interest that's paid by the municipality or school district, in this case, is tax exempt in the hands of the recipient. And therefore, the interest rate can be a tax exempt interest rate that's lower than a commercial rate. So that might be another alternative form of financing to explore for your client along with the PPA. And yes, the full costs of the project, including the additional costs of building a canopy in the parking lots, could all be rolled in on both types of financings. And we could chat more offline. If you're interested, please send me an email.
Great. If anyone has any additional questions or comments, please send those in. I'll just quickly state here that we will share the information from today's webinar with everyone that has registered. So whether you're here live or registered, we'll send you the slides and the link to watch this webinar again by the end of the week. I'd also like to take a moment to thank Stan for doing this webinar with us this month. Stan did our very first ASES webinar with us. So thank you again for joining us again here, Stan. We really appreciate it.
Thank you, Carly, again for the opportunity. I've enjoyed myself today and hope it's been educational for all the participants.
Me too. Okay, great. Well, Drew Gillette, let us know. Great job to the both of us on today's webinar. And with that, we'll wrap it up for today. If you guys have any questions about the content, please feel free to email Stan at cleanviewcapital.com. Again, we'll also share all of this information with you guys by the end of the week this week. Stan, do you have any final comments?
Stay safe, everyone out there. Stay away from hurricanes, fires, and other natural disasters caused by global warming or the pandemic. And stay sunny and safe.
All right, I'll second that. All right, thank you everyone today, and thank you, Stan. We will see you guys later. Bye-bye.
Goodbye.